All right. So I am here now. Sorry for the delay. Let me get some things set up and mute myself. All right, yes. So also let me get this Ernest Chan. Do people call him Ernie? Ernest. Here we go. Open file location. And there we go. Why is it not letting me? Bear with me, if you will. How do I get this thing to open? I downloaded it in some weird format by accident. EPUB or something. Okay. So we'll probably read some of that. Why? I can't have tabs. Tabs are no longer allowed, apparently. There we go. Excalibur, let me come over here, share my screen. Hope everyone's having a good weekend. And I figured out this problem, finally. If anyone was here, maybe probably 3 or 4 days ago at this point. We were having this big problem of, I don't know where it was. A lot of times what will happen when you have a series of things, you're trying to get a co-integrated time series. Let's say you have a bunch of signals, maybe stock prices or something. One way you can do it is you can find the coefficients of, let's say, these two time series, so like C1, C2, that will match it to this time series. So if you take C1, Y1, C1, Y2, C2, and then, this sort of implicitly, this was one of the problems we were having, has a coefficient of 1 times Y3. Then you can sort of fit C1 and C2 so you get closest to 3 in an ordinary least squares sense. So C1, Y1 plus C2, Y2 equals approximately, in a very weak sense, Y3. Now, the problem with doing this was that it was depending on which of these you choose. And the reason Sir Night Night was here and he got the reason correct. The reason is because this sort of implicit 1 coefficient changes the hedge ratio. And so the real correct way to do this, and there's no correct, like you can do it any number of ways, but the most elegant way to do this is you set up for yourself a C1. Let's say you set up, how do I want to phrase this? Like Y1, Y2, ... yn. Everything else is going to be zeros on the off diagonals. You have then a vector of C's, C1, C2, ... C. And the problem here is that if you don't select out a stock, you want this to be equal to strictly 0 everywhere. Right? You want a summation of these that will oscillate the time series, excuse me, around 0. Or in theory, it could be some constant, but let's say 0. And the problem there is that this is basically a homogeneous linear system of equations where the one solution that's admitted is just the trivial solution of all the C's equal to 0, right? And you see how this, not this exactly, but it's this one. Sum Cn yn equals 0. This is just the matrix vector form of this system of equations where you have n of them. So this is going to be an n by n matrix. So it turns out there is this solution called the homogeneous least squares. You can look this up, find papers on it if you would like. But one sort of workaround that seems to be working for me is to simply do the SVD on this matrix, basically. Not quite on this matrix, actually on a slightly different matrix. But I'll show you this. So I have this working. This is now the way where you don't remove any stock, and it looks pretty good. So it's not really homogeneously squares. I'm just calling it that. But the idea is you take this X, which is going to be a matrix of n samples, so however many points there are in your time series, n features, and the features is not really an accurate name. I guess I should call it, like n series. And then we get a solution, which is going to be of the shape n series. So and make some generalized Wiener processes. We can plot these. I think I need to run all the cells because I haven't run anything. Sorry, we're kind of jumping right into it, but it's a good day to get some like technical work done on the package. So here's the problem. When we pick out one stock, some of them are, okay, well, in this case, none of them were stationary. So let's run it until we get one that is stationary. Where do I need to rerun? How about here? Here we go. This red one looks like it will be stationary. Okay, none of them. What the heck? Give me a stationary time series. We will get one eventually. We will get one eventually. Am I running the correct thing? Yeah, I am. You can sometimes kind of eyeball it and see if you might get one. It's hard to tell though. Red, come on. Okay. Well, we're, of course, now that I want to show you, we're not going to get one by chance. So it's kind of unfortunate. But the point is, when you do it this way, take my word for it, you can finally, we got one. You can see here, the fourth one is stationary. So the red one ends up being stationary about 0 when you subject it to the augmented Dickey-Fuller test for weak stationarity. And so when you select out the fourth stock, so that's the holdout stock, and then all of these ones, you're basically doing C1, Y1 plus C2, Y2 plus C3, Y3 equals Y4. And when you do it that way, you get a stationary time series. But for example, when you hold out number 3 or number 2 or number 1, these are all not stationary. So that's very annoying, right? And now I think I have a workaround for it, which is going to be nice. Because this will save massive time complexity for 2 reasons. One, we don't have to implement things if the SVD works. And 2, 2, we don't have to actually keep searching over which stock to hold out to get the best results. If it is better, though, it may not be better. So that's something we need to check. So let's go ahead and do that actually, but I'll show you. So if you don't know what SVD is, let's do decomposition. This is what SVD. It's basically a matrix factorization method. So the singular value decomposition is a factorization of a real and complex or complex matrix into a rotation followed by a rescaling followed by another rotation. So you have rotation matrix U, rescaling, which you can think of as kind of, stretching the eigenvectors, and then another rotation. It generalizes the eigendecomposition of a square normal matrix with an orthonormal basis to any m by n matrix. So this is kind of like a pseudo eigendecomposition for non-square matrices. Because, you need to diagonalize a matrix, but a non-square matrix can't really be diagonalized in the same sense a square matrix can. And so let's see if there's any good intuitive explanation of sort of why it's useful for us. Hi, Esquire. How you doing today? I'm looking to become a risk and get involved in risk analysis, but I would like to mix ML and advanced stuff into it. I'd love for you to do a rundown of the math needed. So risk is usually going to be if you mean on the buy side, that would probably be pretty easy. On the sell side, the risk analysis is much more rigorous. So you tend to work with more simple, um, like regression models in sell side finance if you're trying to do that kind of risk analysis. If you mean like risk analysis in the sense of buy side portfolio management, you could. There's a lot of linear algebra in that. You would want to have like a good grasp on optimization techniques, and there's a good book I had when I did my grad optimization course, which was like the best class I've probably, maybe not the best class, but the most useful class I've ever taken. We had a really good textbook. Let me try and find it. Advanced optimization techniques. Credit risk. Yeah, so you probably won't do, I mean, you could do some ML, but you won't be doing like crazy. So you don't really need to focus on it too much. You could learn what you need in a, couple weeks or something. Portfolio in the future. You don't really swap between those two. You sort of pick a, that would be like a big career change if you were to start in credit risk and then go to some portfolio optimization type of job. Where is this? I don't remember who wrote it. I'll find it later because I can't even put my finger on who wrote the book. But either way, optimization and like statistical and statistics are all you really need for that because the sell side data is much more basic and easy. And you also need explainability in those models because the regulation on the sell side is much higher than on the buy side. In the sense of like your models have to, have rigor in them and be testable, and the things that go into them need to be explainable. So no one really wants you doing like some massive neural network architecture for, analyzing probability of default on an auto loan or something like that. I've been using Gilbert Strang for linear algebra. Great resource. Very good resource. And then pair that with some of those 3 blue, 1 brown videos to get a good, what would you say, intuitive understanding of the concepts of like linear transformations, of what an eigenvector is with respect to the linear transformation, stuff like that, linear forms, all of that. 3 blue, 1 brown has some good intuition on dual spaces. Like all of these things are very useful for thinking about, the space that the objects you're trying to analyze live in when you start doing more complex math. So it's a good thing to look into. But yeah, that's probably the best. I think that's pretty much the go-to resource. So I kind of want an explanation of why the SVD works for this. So maybe we can ask this thing. Why does SVD work to solve the system of linear equations? Let's say C1 y1 plus C2 y2 plus ... plus Cn yn equals 0, while avoiding the trivial solution of Ci equals 0. Keep in mind in this context, y2 our time series, y map t2. Let's see. Cloud kind of sucks for this, to be honest. Let me explain why SVD works for finding non-trivial solutions to homogeneous equations while avoiding the 0 solution. The constraint in the homogeneous least squared problem, we add the constraint that the magnitude of the coefficients is 1. SVD minimization, when we do SVD to decompose a matrix into, these are the rotation, scaling, and rotation matrices, the right singular vectors of rho V transpose are the eigenvectors of XTX. So this is your square matrix that you can build out of this non-square matrix. The singular values, diagonal elements of sigma, are the roots of the eigenvalues XTX. The smallest singular value corresponds to the direction of least variance. Why it works for time series. For time series, we're looking at a linear combination that is most stationary, has a minimal variance. The right singular vector corresponds to the smallest singular value that gives us the coefficients that minimize XC subject to C equals 1. So I'm kind of confused on where the constraint of this C equals 1. Where does the constraint of C equals 1 factor in the, are we using NumPy? In the SV implementation. The constraint is actually inherent in the SVD computation and its output, specifically the properties of the right singular vectors. Here's why SVD properties. When we compute the SVD, the columns of V or the rows of VT are orthonormal. Oh, okay. So because the rows of V are orthonormal, then by definition, the coefficients will sum up to 1. That makes sense. The beauty of SVD is that it handles this constraint implicitly through its mathematical structure rather than requiring explicit constraint enforcement like you might need with other optimization methods. Interesting. So let's maybe play around with that a little bit. So we should be able to get so if we do, let's return, or let's do this, print vh.t at vh. This should give us the identity matrix if the columns are actually orthonormal, and that's what we get. Okay. I still don't really understand why we only take the right column. I guess that's because that's the one with... wait, why only the right column? Explain in more detail. Singular values sigma are ordered from smallest to largest. Each singular value represents a scaling factor in that direction. The corresponding columns in blah, blah, blah. Wait, let's print out S. So the ordering of S should probably make this clear. Yeah, see, this is our smallest one. Singular values are ordered from largest to smallest. Each singular value represents the scaling factor in that direction. The corresponding columns in V and rows in VT represent these directions. So in theory, we could probably look at the stationarity of these different eigenvectors and the corresponding scaling factor. I'm not sure if it's correct to do that, but I found this article in the trading. What do you think of this? I don't see the article. You can't post links in here. Not due to me, but due to YouTube. So tell me what to Google or something. Why this works. When we apply our coefficient vector, xc equals this. The squared norm of this is going to be xc norm equals xct xc equals what have we done here? What have we done here? Whoops. Where? Let me copy this. Well, let me just write it down actually. So we want to write x c equals u sigma v transpose c. Now, if we take if we basically square both sides in the sense of multiplying by their transpose, then this one becomes ct xt x ct equals c v, or sorry, ct v, whoops, I'm butchering this, ct v sigma t u t. Is this what they have? Sorry, I forgot c. Oh no, wait, this is just the left hand part, so then we need u sigma v t c. These should be I believe. Yeah. If this, yes. If these are orthogonal. And then we can have, let's say, c t v sigma t sigma v t c. This just becomes a diagonal matrix where the values on the diagonal are squared because it's already diagonal. C, T, V. So you can, in some sense, just write this as this squared. V, T, C. Is this what we end up with? CTV sigma T sigma VTC. Yes. For any, what is it? For any unit vector C that's a column of VI, the XVI is going to be the variance. And so remember, this is basically XC. So then we apply the same logic to a vector. And if we apply that same logic with, let's say, xv, then what this becomes is going to be something like c t vi sigma sigma vi t c. And this is going to be like epsilon I squared CTC equals CTC. This is just a number now, so there's we can do this. This commutes to here with no problem. I squared, and these are like the variances of the time series. I squared, and CTC is just simply C dot C, and this, because they're orthonormal, is 1. So this is how we come to this relationship of x on some VI vector is going to be equal to our variance. So that's why we're selecting the smallest one, because I guess in some sense the variance on this time series that we get from the co-integration is smallest. But you might not actually want that if you're doing some mean reversion strategy. So maybe we should test with different ones. I think that, but if anyone has any questions on the linear algebra here, we can go back. If you just drop those in the chat. So the crucial part, the rightmost column of V corresponds to the smallest value of sigma n. We get this now, right? This means that it gives us the direction where x stretches the least. In other words, check this Medium article by Paul Lenosky. I don't know who that is. Paul Lenosky? Is that what he said? I'm a professional trader. Looking like, reminds me of the guy from Owl City. Let's see, we have 2 of these. I'm a professional trader. I will tell you how to make money in one article, not clickbait. I bet it's clickbait, though. I've created an indicator. His next article is making technical analysis indicators. Which one? I'm guessing you mean this one. Fucking Medium. I'm not making a Medium account. By reading this article to the end, you will learn how to make money on the market always. Anytime you read this, the person's always full of shit, basically. So that's my first take on this. To do this, you won't even need an indicator, which is what the article's about. Nothing at all. All you need is ironclad patience. Is it going to be some troll thing? It's not clickbait. And considering I wrote one article once a year, I am obviously also not a marketing fraudster. There really is a cheat code in the marketplace, and I don't understand why almost all people don't see it. Except for just a few people I know, my wife and now my mom. I now know a lot of traders. I can imagine. All right. Dude, too long. Here we go. As you would most likely have already guessed, I will teach you how to trade support and resistance levels in a special way so that mathematical expectation is always on your side. The secret is to always stay in the big plus. Why do support and resistance levels work? And it's why the only strategy with why it's the only strategy with the highest mathematical expectation. This doesn't even make sense as a sentence, I don't think. Levels work and will always work for one simple reason. When price forms levels, the price is allocated between buyers and sellers within that range. That is the mechanics of the market. Its very essence. Because of this, support and resistance levels are formed at the moment when who wanted to buy bought. This guy, whatever. If you were asking for my opinion, don't get your opinions from this guy. This guy's like job is writing Medium articles, and he can't even write English. Like, dude, use a fucking spell checker or something. What are the levels to trade? Then the answer is the most beautiful. No. It's too many charts. All this is fake. Don't get scammed. I don't know if he's probably not selling anything or actually trying to scam you, but just all of this is kind of nonsense. And you can be sure of that because it never works for people. And they ask that guy to show you his P&L over the last 5 years. He won't show you. Guaranteed. Which is the tried and true test. I mean, I show you, that's why I always show mine, right, on the Kraken exchange. I think I have 27% in 3 months. And you can see all my trades and everything. And I tell you straight up, it's magic. I'm just looking at the charts and guessing. It's not there's no special chart analysis you can really do to get those price levels or anything. It's like when someone says, I am going to tell you the truth, they're about to lie to you, not clickbait. Is clickbait. Yeah, exactly. Exactly. The more someone has to tell you it's not what you obviously know it is, the less likely it is to be legitimate. You don't see like Ernest Chan in his book saying, this is not clickbait. This is the real secret. Few people understand this. Tip number 9 will blow your mind. Practical meaning. For time series, the smaller XC means less variation in the linear accommodation. So this maybe an interesting application of this is we wouldn't necessarily want that. We want the ones with the most variation, but that also remain co-integrated, right? So let's modify this a bit, and let's simply return, actually. What do we need to return? Let's return S and VH. I appreciate you sending me the article, though. It's a nice, I like looking at articles, so don't, I may roast the article writer, but I'm not roasting you, so thank you for the article. Homogeneous least squares. Let's just do, well, this is totally kind of unnecessary at this point, right? So let's just do this. And come here. And we can copy, or rather cut this. And let's do, for I in range of VH.shape is 0. VH.shape, print VH.shape. Oh yeah, what am I thinking? Okay, so then we have this. What we want to do is we want to plot the time series associated with all of these potential pairings. So let's do plot x at vh what vhi. Yeah. Do we need dot t? No, no, we don't. And how about we also label them? Whoops. Wait, what's happening? Oh, I'm generating the new ones each time. My bad. My bad. Plot.legend. And so you can see, interesting. Well, not interesting. It makes perfect sense. 0, 1, 2, 3. Wait a second. Do these end up being basically the same? So I guess what you would really want is the one that passes the stationarity test, but is the least, is the most variational. I can't think of the word. It has the most variance. Very interesting. So I like this approach better than the basic, just simply having like a dropout column and doing the least squares on those. I think this makes more sense. It also makes sort of, I guess, a little bit more elegant mathematically. So like this sort of is very an intuitive thing when you read this. So let's test these. Let's test these for stationarity. Test time series equals x at vhi. We will update this, and then we will print the stationarity test. Let's have the stationarity test do a little bit more. Where's the test? Oh, did I import it? Yes, I did. Good. So I already moved some of this stuff over to the real code base. Then, let's go to here. Well, I guess I can do this in cursor because I'm open on this file in cursor. Let's go for this file, stationarity test, and let's go ahead and do print. How about some of this to kind of space out the results? Come down here, generate coint. Oh, okay. You'll notice that the test statistics probably, I'm guessing, will continue to improve as a general trend, not strictly, obviously. But I think the trend will be that these will be lower and these will be higher. If we were to run it like 100 times, yeah, like it's kind of strange that the first one ends up being decent sometimes. Wait, I didn't print. Where is... Wait, where's the print stationarity test? Oh, I see what I'm doing. What exactly are we running? This is for the basically when you want to do mean reversion strategies, you need time series that co-integrate, meaning they oscillate around zero. You can think of it as they give you a stationary time series with no drift. And then when you're far from the mean, you can buy or sell the assets with the assumption that they will go back to them. And this is the concept of statistical arbitrage. I don't think financial data passes the stationarity test. There are articles on SSM and academia on what to do to the data to make it work. Haven't read any of them though. Well, you can do it for a single series, like you can difference it until it's stationary, even fractionally. I have that in the Dolphin code. But you can get financial data to pass stationarity test if it's a combination of different correlated time series. So it's more of just a kind of luck thing. Like you can see we're getting very close to some that are stationary. You just need a bit more. Question mark? What's the question mark? See, here we go. We got one stationary finally. This one. You can almost think of the degree to which the test statistic, or let's say like the 5%, 10% critical values are sufficiently accounted for. You could almost think of the ones that are closer to the critical values as more high risk, because they will necessarily have a larger eigenvalue in this sigma matrix. Sorry, I'm new to all of this. What are we running or trying to prove? Well, so like the basic idea, so we're doing I'm making a statistical arbitrage package. And the key notion of statistical arbitrage, like when you have a stock, the most basic thing you could do is you have the stock price and you try to predict when the stock price goes up. Right? That's the basic idea that, everyone's first thought when they think about stock trading is you want to predict when the price goes up, obviously. But this turns out to be like a very hard problem that really is not feasibly doable, except when you are privy to information that other people aren't. Simple as that. And that's much harder to get. It's not price data. Price data won't predict this for you. The news won't necessarily predict this for you, things like that. So this problem is basically unsolvable. Unsolvable. Not literally, but it's very difficult to solve. So it turns out that a much easier problem is to say, find two assets that have some correlation, which is grounded in some logical line of thinking. For example, maybe I'm just going to make up something. Like, let's say the ski resort is negatively impacted by high temperature. So in a year where the temperature is high, the ski resort goes down, their stock, right? Ski resort. Then the other thing is a beach volleyball team, something like this, where when it's hot, you play more volleyball. I don't know. Well, to predict whether the price is going to go up or down, you would need to know the future weather, which is a difficult thing, right? So, but the fact that they're correlated makes it so that if you buy, let's say half of your money is volleyball, half of your money is ski resort, and you were to add those up, then it might look something like this. And the key thing here is that when one goes up, the other goes down. This is a very oversimplified version of it. But when one goes up, the other one goes down. So if this one goes up, this one goes down. If this one goes up, this one goes down. So what you can do is you can buy each of them in some specific time windows. And when would you want to do that? You would want to do that when they are far from each other in price, which is when they are not near zero. So in some sense, there is an arbitrage opportunity here. Arbitrage just meaning arbitrage opportunity. And the arbitrage opportunity is that statistically, these things tend to be correlated in price. And so if one is going up, one's going down, you buy the correct amount, then you can have, on average, your portfolio stay flat, completely flat. But there will be statistical fluctuations. And so when you have one of these pairs like this, you are engaging in a statistical arbitrage opportunity. That's the name, statistical arbitrage. And so in order to do this, you need to find pairs of stocks and things like that, which have this type of relationship, that when you buy some amount of stock one, some amount, or maybe you short one, long the other, It depends on their correlation. And then, you know, you just carry out this procedure and hope it works. And if they remain co-integrated, then it does work. Assuming there's a lot more to it than this, but this is the basic idea. What pair would be an example? GLD and GDX from the book. Ernest Chan. Let's see. GLD, or probably GDX. Yeah, here we go. We can read this if you want. Now, this example will illustrate how to separate the data into a training set and a test set. Okay, GLD versus GDX is a good candidate. So this whole thing here is called pair trading. So pair trading, it's kind of like there's statarb. And then one example of statarb is pair trading. You could also do it with a basket of securities. And in this book, where is it? I lost it. GLD versus GDX is a good candidate for pair trading because GLD reflects the spot price of gold and GDX is a basket of gold mining stocks. So you can imagine when one goes up, the other goes up. Ernest Chan book, yeah. The details linked in the Discord. So it can be used for hedging. It's not, it's not exactly hedging. Like, because, can you share the name of the book? Yeah, sure. It's this. I'll zoom in. Quantitative Trading, How to Build Your Own Algorithmic Trading Business. Like in some sense, it's somewhat similar because you are technically like hedged theoretically, but it's not like hedging in the sense that you would hedge with derivatives or something like that. It's more of like capitalizing on just statistical fluctuations in correlated price movements, or in price movements of correlated assets. But it's more than just correlated. You can get correlated assets that don't generate for you this kind of stationary time series. Very easily you can get that. So, yeah, so here we got one that works, finally. Oh, did I mute myself? Hold on. Let me go to live. No, we're good. Okay, yeah, so we got one that works. And it's the red one here. I'm just kind of thinking of ways that we can... Thanks, yeah, no problem. Trying to think of ways that we can sort of benefit from this, because the good thing about this approach is that the solution for the... well, I guess either way it would have been pretty fast, but anytime you have something that is just a basic linear algebra operation, it's going to be very super efficiently implemented in like a million different ways. So we have something nice here. Let's do in the code, let's integrate this. Preds, time series, stationarity test, ACF, and then what we will do is let's do def co-integrate time series list. And num, candidate series. So I'm trying to think of what kind of information we want to store in this time series class eventually. The idea will be that you pass in your collection of time series, and then you have all sorts of metrics about these time series that might be useful for detecting regime shifts in the statarb strategy. So the problem with this type of a thing is in the real world, many assets don't stay. Like say you find this relationship, many assets don't stay like this. So they may be co-integrated for a time and then shift off of that because of news or something. For example, let's say you have some Forex, pairs trading strategy, and it relies on, let's say, an economic relationship between India and the United States. Well, if that economic relationship changes ties when you have a new president or something like that, you could very easily imagine the once correlated pair of assets is no longer correlated in the same way. And so the big concern with statarb is you have this co-integrated time series. This would be a great one if you had something like this. But the same signal that you look for entries on are the signal that would lead to you losing a lot of money. And so a typical like equity curve for a statarb strategy would be something like this. It's going to be kind of like very slow and steady, and then a big drop. If you were doing one pair, let's say, slow and steady, big drop, stuff like this. And the reason, and obviously, then the name of the game is to mitigate this as much as possible, right? But the reason this happens is because you consider your entries when the stocks become, not so quote unquote. It's not. Don't take what I'm saying literally in the mathematical sense, but when they become less correlated, that's your entry point. It could also be here. And the issue with that is, of course, that if the co-integration were to break, that also looks the exact same. And then if it doesn't go back to here and it goes out here, you lose a lot of money. So that's why this is the typical equity curve for a statarb strategy. So the name of the game is having regime detection, which can hopefully tell you if this is going to be mean reverting or if this is going to be like a broken co-integration. And if you can do that, you're screwed. Or if you can do that, you avoid getting screwed, basically. Decoupling equals you are screwed. Yes, exactly. That's funny. I didn't even read that before saying that. Yeah, so this is your standard approach. Whereas like a momentum trading equity curve might look, more like a stock or something. You maybe have some big wins, but you're also used to having losses in there. These strategies very rarely lose until you have one of these like catastrophic events. So it's a much higher Sharpe ratio, basically. And when you have these high Sharpe strategies, you can leverage the heck out of them insofar as you are good at avoiding these. Now, I mean, I'm not saying you should do that, but that's what people do. Okay, so let me add this to the code. Seems like that could possibly be a way to detect breakouts that are meaningful. Yeah, that's true. That's why, Ernest Chan, not in the book. I was watching some interview with him a few weeks ago. He was saying like you need to know when it's the time to be doing momentum-based strategies and when it's time to be doing kind of his bread and butter, which is the statarb stuff. But he said he does both. But you're definitely right that it's usually something. If there's a good logic for the co-integration, there's usually some kind of event that will cause the breaking of the co-integration or the decoupling, as you put it. So that's pretty cool. So we can do co-integrate time series. Oh yeah, so that's what I was thinking. What do we need in here? So for each time series in the data set, what do we care about? We might want to know things like its volatility. Yeah, so let's start implementing some things. So this will be the class for a single time series. And we'll implement things like def compute. I think I need to. Oh no, that's good. Compute rolling volatility. Def compute rolling, no. Def compute rolling mean. Why does it really want to do the correlation? We don't really need this, right? Can I do, I always forget how to do static methods in Python. Static method, because I want to be able to call these without having to instance time series every time. But wait, can't I do? Oh, wait, how do you do in Python? I forget how you do this. If I want to be able to call compute rolling volatility as a static method, whoops, or for a specific instance of time series, how do I do that? Because if it's static, you don't have the self attribute. Oh, you need to implement both. Is there really no way to do this? Is there really no way to switch between based on the object calling the function? Oh, this is it. Class method, decorator instead of static method to create a method that can handle both cases elegantly. Here's how to modify the code. Class method, compute, CLS. If data is none. If has attribute class data. Okay, this is what we want. I don't usually code in like a real object-oriented sense or whatever. So the idea here, hey, just found out you have a Discord server. Where can I find the entry link? Top of the chat. I'll send it again. Let's go here. There you go. There it is. Now you can use it in both ways. Nice. Okay, so this is good, I believe. Compute the rolling mean, CLS. So what happens here is CLS is the object, basically like self, right? And if this is instanced and has a data property, then this will work. If it is not, then we are going to, and then we are just going to leave this and then calculate the thing with data as normal. So basically, you just need this wrapper that pulls the relevant info from the instanced object if you are calling it from the instance object. Otherwise, you have to pass in that information. So we have this good now. And I believe that when you call this as well, does it need to be a keyword? No, it doesn't. Yeah, when you call this from just a static sense, you don't need to pass it as a keyword. You can just take it to be like the positional order of the arguments, not including this one. Okay, so we can do this now. And which should be good. So we compute rolling volatility, compute rolling mean, and let's test how this is working. So let me close out of the file explorer. This thing always takes, I need a bigger or a high resolution monitor. Actually, but I think that would look terrible on stream. So maybe not. So time series. Why is it correcting that? No. I don't know why it's trying to correct that. Well, let's see how this goes now. Oh, this was some machine learning thing I was messing around with. And I think we're good here now. Let's open the two side by side. Not loving this color theme. Let's go for something lighter. This one's fine. So compute rolling volatility. Yeah, so can we get rid of this check coint? Yeah, we don't need this anymore. I'm going to start, whoops, I think I deleted too much. No, it's fine. just clean up the notebook here. So yeah, so we can generate these, and then we can take this, plot, ensemble of wiener processes. Why is the, oh, whoops. And then we can come down here, copy this. And paste it here. Well, I guess I don't need to do this. And we could add more, and typically the more you add, the more likely, statistically speaking, it is that you'll get something co-integrated. But the more expensive it is to deploy the strategy, and the less likely it is to be grounded in some good financial logic. And so you see we get one. We don't need to print them all anymore. We'll do this. If print all else, we'll take the last one. Test time series. Print all is not defined. That is true. Print all equals false. Yeah, and you see this is pretty good. Now, some things on the to-do list. Here we go. To-do list for the package. Whoops. Can we have this be white? There we go. To do. Backtesting. To entries, exits. Whoops. Cumulative PNL. What else do we need? We need, let's break this up. So for strategy, backtesting, entries and exits, cumulative P&L, and then let's say like time series statistics. These will be things like standard deviations of F prime. I'm just going to call F prime our co-integrated time series. This will be also things such as coefficients and history. This will be, let's say, a confidence of remained coint. So I'm planning on having it look something like this. You would have your co-integrated time series, and then below this, what I want to have is this function C of t. And this C of t is basically going to be, let's see, if this is our 0, it's going to be somewhat low, probably. It's going to be between 1 and 0. I should say this. So this will be like 1, 0. It will usually be very high, the way I'm thinking of formulating this. It will be very high when you're around the mean. It will go down as you exit. And so you can think of it almost like as a mirrored kind of, how do I say it? The function itself should look something like, if this is our F prime, then it should look something like negative absolute value of F prime. Should be proportional to this. weekly. So whether you're high or low away from the mean, you want this to go down probably. However, the key thing is that I want it to, so let's say kind of, I'm not going to draw this accurately, right? But just something like this. So it's pretty confident while you're in the co-integration regime. But the goal is to have a function that before the co-integration breaks, the confidence goes way down. So you can hopefully not enter at these positions. And this is the key thing that avoids these. So that's kind of the name of the game. So there are a few challenges. Like the challenges, one, find pair / basket. Nobody, well, few others are trading. Formulate and keep updated holdings plus coint coefs. Regime detection for, what did you call it? I liked what you called it, decoupling of assets. Yeah. So these are kind of like just the overarching challenges. And then here are some of the ways that you beat these things. So the strategy builder is needed. Also, kind of like statistics, I guess. Statistics on time series. You can imagine these will be factored in as features. Volatility, autocorrelation, drift, kind of like momentum, and a lot of other things. And right now, so these are on the non-co-integrated time series. So on the co-integrated time series, on coint time series, I have a lot of time watching. I have a lot of time watching the markets in oscillations. It's the second impulse that's less strong that will signal the possibility of a move. I wonder if it's similar in a pair comparison. I think I know what you mean. Spell check? No, I know what you mean. So you're saying like, let's say you have some reasonable price movements. Let's say you get one sort of big move, right? This is what you're calling like, let's say impulse, first impulse. And then after some time you get like a less significant one, but you're saying usually you think this is the one that signals a big move to come. Ernest Chan said, "Do you need at least 100 grand for the algo trading? Do you agree with that?" Yes. I mean, well, yeah, I mean, it depends what your goals are, right? So if your goal is to be able to withdraw monthly to pay for your living, you need probably way more than 100 grand, depending on how much leverage you trade on. You don't need 100 grand to get started. But if you're trying to be profitable to the extent that you want to like make trading your job, like if you can't get 100 grand, go look elsewhere for something to do, because it will be difficult, or go trade for a prop firm. I understand what you explained. Okay, good. Yeah, maybe it is the same. We'll see. We will see. Statistics on coint time series. Now this is where we want, let's say, sigma bands. What else do we want? This kind of confidence function. So this should not really be here. Well, I guess all of this should be down here. I'm absolutely butchering this. I'm butchering this. I'm just going to rewrite it. Sigma bands, coint, coFs, plus propagation. What else? Confidence. Function. Probably this will be machine learned. In part, not fully. Like there needs to be some mathematical structure and then machine learn some parameters to it. Not just machine learn the confidence. And yeah, I don't know what else. So let's work on this right now. Now, what's going to be the best way to store this? So these are going to act on, I don't know where to put it. I want some set of things that only act on the co-integrated time series. Where the heck is all my, where's my code? Oh, I changed the color scheme. Okay. Also, I wonder if you could measure decoupling potential by comparing different time frames. Maybe. I think you need a lot more than price to predict the decoupling, though. That's my intuition, but it could be wrong. So let's have class co-integration methods. And none of these will be static. So, because, yeah, this is going to be for a co-integrated time series. Co-integrated time series, yep. No. Def init self time series list num candidate. I'm debating sort of if I want to just do this all functionally because I kind of just hate object-oriented programming as an entire entity. Like I'm trying to think, what is the benefit of actually doing it this way as opposed to just having a bunch of functions? Yeah, this is dumb. I think it's dumb, so I'm not doing it. Stationarity test, we have this. ACF, co-integrated time series. Okay, and then what we can do is we can do sort of... where's the thing that tests? Oh, it's right here. So then we want def time series sigma bands. What would I call this? Distribution. No, what would I'm trying to think of time series standard deviation. Time series. Then we can do this. Return time series dot mean. No, let's do this. Mean equals n bands. We'll look at let's look at 3. Time series dot mean. And we'll do How do I want to do this? Mean plus n times STD for n in list range minus n STD n STD plus 1. Bands. Return bands. I think this will work. Let's see. Can get rid of this. So we have our co-integrated time series. I'm going to call this coint. So we have this time series, oops, STD coint time series and STD equals 3. Probably need to import this. Whoops. Whoops. From star B. Okay. So then what we can do is we can do bands equal this. Whoops. Then we'll do for banded bands, plot x h line, and we will do plot coint time series. Color equals k, line width equals 0.5, color equals this, line style. Here we go. So these are kind of the bands of the time series. So these are your points where things are sort of going well. And, well, maybe we should have these be different colors or something. Colors, let's zip up some colors here. Zip for col. We'll do colors equal, yeah, sure, something like this. RGBYMC. C is not a color, right? Let's see. Negative is not value. Oh, I zipped them the wrong way. Colors, bands. Yeah. And then we can make these much larger. And plot.legend. Why no legend? Oh. Not the most useful. Band. I don't know why it's doing that. Well, this is very annoying. I don't really care about the visualization. We understand. -3, -2, -1. This is your mean. This is +1, +2. Oh, wait. Am I missing one? Oh, wait. Did I do off by 1 somewhere? For list range minus NSTD up to NSTD +1. I thought the +1 would account for this. But I guess why do I need 2? Makes no sense. Huh? I'm so confused. Huh? Parental land bands. 16. Oh, because colors isn't long enough. Whoops. Sure, that should be good. I forgot. I hate. There's a very annoying um, thing in Python. It's the zip function. It's because zip only goes up to the longest. What do you call it? Shortest list. Sorry. So we didn't have enough colors. So this will work now. And I can stop this. So I guess this should be 2. I don't know why. I think it should be 1. I think it is just the problem was. Yeah, this is correct now. And let's get rid of this label is disgusting. 0.1f. So that's at least a little bit better. And probably make these like 4. Yeah, doesn't look the best, but gets the job done. And we could also do something like a rolling mean of this. Plot 25 period moving average of the quant time series. NumPy has no idea. Rolling, what is it? Moving? What? NumPy and array. What the heck? A equals NumPy a range 20. A dot rolling. Why? What is it? Isn't it moving or something? NumPy rolling average. Never ending. I'm wrong. No, we're. It was just it's because zip has stupid behavior. It's very dumb default behavior, in my opinion. I think it should throw an error if the two things you're trying to zip aren't what do you call? If these aren't the same size, this should throw an error, in my opinion. Convolve ones, ugh. I don't know why. Oh, never mind. I know. I see. I don't know why this won't work. NumPy convolve. The idea behind this is to leverage. Are you on iPhone? I bet you're on iPhone because whenever I'm on my Apple devices, the spell check is so aggressive compared to any other spell check, native spell check I have on like a phone or anything. Convolve. Let me read the docs here. NumPy. Discrete convolution operation is defined as sum of m minus infinity to infinity a m v n minus m. Can be shown that convolution x y is equivalent to the multiplication of this in the Fourier domain. Yeah, but this is had an iPad, just got Samsung this week, not accustomed to it. Oh, okay. Wait, why is this used for the moving average? NumPy moving average. X NumPy 1's n by n. So we want to convolve. Oh, yeah, that makes sense. Yep. So we can do this. we'll say 25 SMA 25 equals this. Nope. NumPy doc involve coint n, and we'll say n equals 25. NumPy ND array has no attribute rolling. I thought I got rid of it. Whoops. And then we'll do dot plot. Okay. This will kind of smooth out these annoying scenarios. Let me make it real quick. I just do this in Plotly so I can zoom in. Ugh, Plotly plots are so nice, but like all this code is just, come on. It's not where I wanted to put it. No, come on. Cursor's gotten worse, I swear. Come on. Did this fucking editor suck sometimes? Oh my gosh. Do this in Plotly. It's so bad with Jupyter Notebooks. I'll help you convert this matplotlib to Plotly. Thank you. Copy. Nice. So the idea I'm thinking of, SMA in this scenario is good because it will avoid these annoying scenarios where, let's say, our entry is 2 standard deviations and the exit is 1. It will, or let's say the exit is 2 again. Okay, I don't know. I'm just saying, making something up. But when you have these very noisy time series, I think that the smoothed version may serve to aid in getting rid of this, but I think it's maybe too much. I guess you could just add a condition that if I don't know. Trying to think. I think I actually don't like it. Changed my mind. So we have the real-time series here. So the entry condition could be 2 sigma. Exit condition could be 1 sigma, by example, as a take profit. And the, quote unquote stop loss could be 2.7. So yeah, this ends up being pretty reasonable. So yeah, so I guess I will do that. Now what do we need to do? Vim signals.py. Well, I guess I'll just do touch signals.py. Come over here. And then what we will do is def. Perhaps make another plot of that change style, strictly for timing your entry and exit. Do you mean the moving average thing? I'm guessing. Find, or let's say, standard cross time series, and we'll do an STD. Let's say no. NumPy.where time series. Oh, we need to do this for all the bands. For band in bands. And yeah, here we go. Yeah, exactly. That's what I'm doing. So what we're doing here is a good video explaining how the tanh gets your line closer to the real data. Wait, what data? You're saying tanh as in like hyperbolic tangent, right? I always spell tanh like with a C. Oh. SMA shifted right. Interesting. It's a pretty recent relevant paper too. I'll look at it when I'm more close to having the thing actually run. So for band and bands, time series low, time series greater than band, and time series shift 1. Wait, is this right? Time series is greater than band, and time series shift is less than band. This should be -1. I think, right? We'll see. And then what we can do is... Wait, this is... Why are we on loc? This is going to be NumPy, right? NumPy dot... Oh, boy. NumPy dot where? Then what we can do is... Let's say above to below, below to above. Then we'll say how do we want to do this? Probably something like this. Signals equals this. Signals band up equals below to above. There we go. I think this should work. So we will see. Quant time series. Hi, if you send the link of the... Wait. Hi, if I send you the link of the curriculum of the Computational Business Analytics Bachelor Program at the university, could you give some feedback by email? Honestly, it sounds like kind of too much. And I'm not a business person also, so I'm probably not the person to ask there. If you're trying to get into quant stuff, don't do business. That would probably end up being my feedback. But Yeah, I would not. I don't think I will be reviewing like full programs unless the program asks for it. That's one of those little drama things where if you are even adjacent to academia, you are best not doing it. No, no, don't no worries at all. But um if the goal for you is quant, try not to do. I wouldn't do business analytics. It will not really help you too much. If the goal is to have some different fallback or something, that's a different story. But um, yeah, it's the problem there is that there's just not enough quantitative work that you'll see in a business, even a business analytics degree. But I could be wrong too. I'm not really an expert. That's just my sort of knee jerk reaction to thinking about that. Maybe it is good though. I don't. I do. Maybe it's good for like more traditional finance role. Import. Whoops. From starb dot signals import standard deviation cross std cross, and we have, what do we have? Signals. Time series standard deviation is not defined. That is true. Vim signals. What is it? From starb dot time series import standard. Wait. Def. Time series standard deviation. Time series. There we go. But can I do this? Oh, whoops. Import numpy as np. This should work now, but it might not. So we'll see. Oh, why are we still locking? Wait, where's lock happening? Numpy.where. Oh, this needs to be in here. Numpy.where time series greater than band 0. Oh, shoot. Is this going to work? It needs to not be where. Time series greater than band and this. Time series dot roll. Can I do this? Numpy dot roll time series 1. How do you do it? No, shift, right? I forget. A equals numpy to a range 10. Can I do a dot shift? Roll? What is it? Numpy dot roll a1. Oh my goodness. What's the thing to shift the numpy array? Shift numpy array. I used to know pandas and not numpy. Now apparently I know pandas. I mean, I used to know numpy and not pandas. And now it is apparently vice versa. What? What is this thing talking about? How do I shift a NumPy array by one element? Why is it? Did I not just do that? What the heck? Oh, I did the a.roll, didn't I? Why is it? It's doing this. Oh, I am all over the place. This should be 10. Yeah, but also we want this to not be occurring. So what's going to be the best way to... This edge case needs to be dealt with. And we can just manually set that one to 0. Time series greater than band and time numpy.roll time series 1 less than band. We need this. And we need the logical and here, I believe. I think this is going to work. With possibly the exception of the 0th element. So we'll have to probably handle that. I'm not sure the best way to do that right now. But we can do the same thing here. NumPy.where time series, nope. Now needs to just be time series less than band and numpy.roll time series 1 greater than band, and that should do it. Oh, wait, this needs to be here. Okay. Signals up below. Yeah, this should be fine. And in here, I think I have some issues. Yep. Import numpy as np. Oh, shoot. I hope I didn't just overwrite something. NumPy. Sorry, I just had to adjust the mic there. Now, oh shoot, what am I doing? Oh, I was on the other monitor. So what else? Do I have any issues in here? This was saying there was some issue in the standard deviation function. Yeah, this is correct. So this needs to go. This whole thing can go for now. Time series mean. Yeah, we don't need any of this right now. Where's the thing with the bands though? Oh shoot, did I overwrite or something? I think I overwrote before saving from VS Code or Cursor. Well, that's a bit annoying. So now the thing to return the bands is, oh, is it this? N times std. Oh, I do need this. Std equals time series dot std. Yeah. So that should work now. We should be having no problems here. Key error. Oh. How about we do STDs bands? Them signals. Time series. STDs. And then when we do this. This is right. This is wrong. We would want it to be signals std. Then we'll zip these. Zip stds. Undefined name std. Whoops. Can zoom in a bit here. So this should, well, now I have to update the time series std class or function here to return what do we want? We want list range minus an std and std plus 1. Whoops. What did I do? And then we can, instead of this, we can just do, cleans things up a lot. And now we can return both of these. Justin Doherty's this data science guy. Did I miss a message? I don't know this guy. Return standard deviations, bands. STDs, bands. So this should now work, right? Can't multiply none. Okay. STDs, bands. Bands, STD and STDs. Too many STDs going around, I think. The video listed above. Oh, it blocks links, so I didn't see it. Video listed above, kernel regression, moving averages on steroids. True, yeah. Kernel regression and like all these ridge regression type of things are basically like OLS dialed up with regularization and stuff. And any sort of like time series machine learning or really just regression technique ends up looking, if it's decent enough, like a smoothed average, moving average. Where does this problem arise? Bands, numpy mean, bands. Let's take a look. Line 82. This is, wait, why is this? Can't multiply sequence. List range, print STDs. Oh, why is it a list of a list? Oh, because I made it a list of a list. There we go. We can get rid of this print statement now. And now this should work. Error -3. Oh, yeah. Whoops. So this needs to be for, needs to be, what does this need to be? STD empty for S in STDs. I think now it will work. Okay. Print signals. Well, it's not working. For K in signals dot keys print This will clean up the print a little bit. So it's kind of working in the sense that it's getting there are more crossovers about the mean, and there's less about the first standard deviation, less for the second, and 0 for the third. So it's sort of doing something right, but the numbers being stored are obviously not quite what we're looking for here. So let's see. Time series greater than band. Let's why can't I type? Let's go for, well, let me paste that here and let's print this. It's not going to let me. Print this. So we get some trues. The indices are not being selected correctly, though. And so these ones where it happens on the 0th element are a problem. But it seems to be kind of working. It's picking them out, but this is something's not quite right here. A2b equals numpy dot array. Let's do this. Numpy dot where A2b equals true. Above to below. See if this fixes things. No. So what are we storing here? Above to below. Let's print this. Print above, and then we'll do a break here. Why is it empty? Well, because we're starting on the 3rd standard deviation, which is empty. This is weird to me. Something's going on here. Print A2b. So zero, but you can see sometimes there are I don't understand. What is the bug here? A2b numpy array time series greater than band, numpy roll time series 1 band. A2b. What's it saying here? Oh. Does it need to be is? I don't think that's going to fix it. I really don't think this will fix it, but yeah, no, that's not it. Why is it getting the wrong indices? Well, how about what about just this? Why is this not working? Let me open this in this thing. Why is this returning all zeros? when the array looks something like true, false, false, true, false, true. You're creating a 2D array with an extra dimension by wrapping the Boolean expression. Oh. Shit. Why was I doing that? There we go. Why the heck was I doing that? Oh, it's because I was using NumPy where in 2 spots originally. That's why. Okay, easy fix. Okay, nice. Now we can do, let's get this disgusting plotting thing to be fewer lines. And then let's come up here and add some plots here. So we probably want to add, well, let's plot these. Let's plot the crossovers for the 2. Cross sigma 2 sig, we'll say equals signals 2. And then we will say for x in up, no, add, whoops, add an x at the x position given by at the x position and the corresponding y position of coint time series. Here we go. Doesn't quite look correct though. Oh no, it does. This is when it went from up. Wait. I have the up and down wrong. How do I have that wrong? Wait, so above to below. Let's also do this. Whoops. So if time series is less than band, and when we roll it, it's greater than band. This is, yeah, this is above to below. Whoops. I had that mixed up. Yeah. Yeah, because the shift moves the array forward in time. So that would be the prior, this is the prior time being above band, and this is the current time being below band. So this should be above to below. Yep. I always mix that up. Not very good at that. Local variable. Oh. Now let's see. So this is below to above, correct? Yeah, so this is when it goes up. Below to above. Below to above. So this is the kind of thing you want to try to avoid. So it's good we have some examples of that. Same here. But this is pretty easy to avoid. You could just have some raw, like just manual conditional, like if the most recent entry is within, however many, whatever this time axis is, you could choose some region there where you wouldn't want to enter into the position again. Okay, so that works. And let's also do for y in across 2 sig down, across 1 sig equals signals 1, and we'll do this. How about, wait, what did I do? Oh, I need to do fig dot. Yeah, here we go. Let's make these one. Oh, I just saw your question. 1 second. Let me just get this plot working. There we go. Any books you have referenced to create this project? How long have you been working on it? Like, this project's like 2 days now. And any books referenced? Not yet, really. Kind of just the working knowledge of statarb, and then I'm trying to get just like your basics implemented, and then I will need to reference books when things get more complicated. But for now, just kind of getting the basics into the code. I've had the code up and running, but this is only the second day actually working on it. But there's not too much in the code. I'm still looking for a good book on statistical arbitrage, so I'm sort of in the same boat as you there, looking for one. But I will, once I find it, I'll drop it in the education resources section on the Discord. Here's the Discord link if you want to join. I'll try it because we're getting to the point where most of the basics are going to be implemented probably by today or tomorrow. So I will need to start looking for more resources as well as doing some model development. Mode, markers. I don't like the legend. It's kind of annoying, but can I turn that off here? Defaults to. Can I do, I wonder if I can do none. No. There has to be a way to turn off the legend for these scatter points. Oh, here we go. Show legend false. No? Oh. There we go. There's no underscore apparently. So we can do this. How about? Okay, sounds looks very organized. Is there a framework, or is it just a function for receiving the live graph, or you're coding that as well? Yeah. So the idea for the code is it will be used on real financial data, but a lot of times when you're testing these strategies, you want to be able to just spin up some kind of synthetic fake data. So currently the code has tools to do stuff like simulate Wiener processes, which are like a basic sort of, naive model for a stock price. So I just have it using like these 6 dummy stocks. And then that's the data we're working with. But then when you want to do it on a real thing, you replace this with your real stock data. And so the idea is you have all these different stocks and you want to find a co-integrated time series from those. So that's what's happening in here. So simulate generalized Wiener process, stationarity test, these are all in the code. And so you simulate your time series, you combine them to get the best fit for the time series, and then you test if it ends up actually being stationary. And then if it is stationary, then you can do your statarb on that time series. So here is that co-integrated time series. And then here are the bands, which are the different standard deviations in price of that time series. And then down here are the theoretical entry and exit points. If you, for example, wanted a strategy that enters when the mean reverting time series is 2 sigma from the mean, and you sell when it's 1 sigma from the mean. I am a 17-year-old student from Germany. What should be my career decisions wanting to get a role as a quant? I have strong interests in physics and also math. Interesting how many physics people want to become quants. I think it's because, well, I don't know why that is, but it is interesting. We have like a way over representation, statistically speaking, of physics people in the Discord, which is a good thing, probably. Maybe. Well, probably, yeah. But what should you do? Get into the best school you can for undergrad, and then you will, by the time you're done with undergrad, know if you want to do quant research or trading and stuff. So try to get internships while you're in undergrad. But for now, just focus on getting into the best school you can. That would be your best bet. So we would enter here, sell here. I guess a part of this, though, is I think when I was earlier saying you want the time series to be oscillating a lot, that might not be true. Because that just means you have a shorter time frame, which could be a good thing, but it's not inherently a good thing like I was thinking before. So that's something to think about a little bit more. The legend equals false. Why do these look so large? These are quite large dips here. Which I'm not, which I'm not sure I like. But in a real environment, this will not be the case, I guess, probably. So, I mean, we could do something where we backtest the strategy. Oh, I also need to deal with these strange cases at 0. So probably, how do I want to do that? So the reason that we have these strange scenarios at 0, not necessarily here, but it's because when you roll the numpy array, the last one gets put in the first spot, so that's not ideal. In Germany, universities don't differ much from each other, especially with degrees like physics. Oh, okay. I didn't know that. Then, well, yeah, then get in whatever one's closest to your home so you can, well, I don't know. I'm kind of mapping American concerns onto your educational situation. So I don't know if it's a big deal, but the first thing I think of is if school doesn't matter, then go to the one closest to home so you could stay living with your parents and save money. But maybe if your schooling there gives you housing or something for cheap, that's also not a concern. And then in terms of your education, just focus on getting those internships as soon as possible. So get your math skills up, get your coding skills up, and do that with projects. Don't do that with tutorials and stuff like that. So follow along to projects we do on the stream, try and implement them yourself, add your own twist. All that kind of, I mean, maybe you can't do all of it right away, but try and take some concepts and see what you can do with it. So these zeros need to go. I don't know what the best way to get rid of them is, though. Oh, we can also get rid of all these print symbols. I should start documenting the code as well. Computes the indices at which the requested bands of the standard deviation are crossed in the co-integrated time series. These can be usually thought of as entry/exit signals for long/short positions with respect to the how would you say this, mapping with respect to the sign of the co-integration coefficients. Yeah. Is that right? Yeah, that's right. And we will say parameters. Time series numpy.end array. The time series of shape, and it needs to be n samples, which contains the data for the co-integrated time series. And STD, this needs to be fixed because currently the logic in here, so yeah, this needs to be fixed. The reason it needs to be fixed is because you may want, there's nothing special about integer or standard deviations. So maybe you want your entry to be 2.5 standard deviations and your exit to be 0.25 or something like that. So currently we are doing integers only. So really it should be something like STDs are an argument. STDs always tend to cause arguments. -3, and we'll give the default of -3 to 1. 2, 3. I think that will do it. Then we can get rid of this. Yeah. So the default behavior here is to go from -3 to +3. But now it's set up that it could be passed in as something else. Standard deviation cross, and now we should pass in STDs equal none. There are too many things with the same name. Well, yeah, this is maybe not the best way to do things, but it's fine. This will still work, and we can test that. So this needs to now be, let's do no argument and see if it works. No. Got unexpected argument, keyword argument. Oh, because I didn't change how the call signature goes. or where? Line 6. Oh. Wait, why am I running this twice? Oh, no, no, no. Yeah, this is fine. Now it should work with default behavior. None type is not iterable. Standard, oh. We'll say if is none. We need to, we can't pass in none because then that will overwrite the thing. Else. Well, this is just sort of tedious. Getting this argument signature to match. Here we go. Why is this? So, what happened to these ones? Huh. What happened there? What would you recommend to learn more about finance and therefore get ideas which I can base potential projects on? Read textbooks, I would recommend. Maybe you could read the derivatives textbook. Options, what's it called? Options, futures, and other derivatives. Yeah, this one. Give this one a read. It is pretty basic, so even with high school math, I think you can get through this pretty easily. You'll see, I mean, especially the first, let's say, intro, hedging, interest, forward future prices. I think up to about chapter 11, you'll be fine with for high school level math. Beyond here, just give it a read through and see what you can understand and sort of piece the math together for yourself as you go. Can you download the book? Yeah, just type it in. There's PDFs pretty much everywhere. John C. Hull is the author. Where is it? Yeah. John C. Hull, Maple Financial Group Professor of Derivatives and Risk Management. That's the guy to go to. The Professor of Derivatives. Yeah, you're welcome. No problem. Def Time series. So what was the... Oh, yeah. So why are these... What happened here? I think it's in this. Zip, colors, bands. Let's print these. So there's 7 of these and there's 7 of these. So what's going on? Are they... Ah. I see. Something is wrong here. I must have only done negative for the first one. Yep. Whoops. Now we can get rid of these prints. That'll fix it. I forget where the prints were. Oh, okay, now it's fixed. So the purpose of this was now we could imagine doing something with a more, less normal selection of the standard deviations, we could do something like minus 2.2, minus 1.6, minus 0.40, and then the other side here. Did that work? Wait a second, did that work? Let's do something like why is it doing this? Let's go like minus 5, minus 1, 0, 1.55. Why does it feel like it's not working? Feels like it's not doing anything. Brent. Oh, it's not doing anything because we need to do this. There we go. I think now it's working. I might be overwriting something somewhere. Because this 5 should be... Oh, actually, no, that makes sense. Let's try something like 0.1, 0, 0.1. No, so what's going on? Things are not working. Oh, I'm not passing them in. Oh, yeah. Well, that's kind of annoying. Okay, there we go. All right, so that's working. I just had a feeling something wasn't going properly. So come over here, go back to minus 2.5, minus 1.5, 0, 1.5, 2.5. Why? Yeah, that's strange. Oh, we never crossed the 2.5. 1.8, 1.2. Yeah, okay, this is working. All right. So I think I might stop here. Tomorrow I'll probably be reading the thing. And I think I'm also going to start really, and when I say reading the thing, I mean reading the Chan book. I think I'm sort of ready to start live trading one of these strategies. So we will see how that goes. And Tasty Trader kind of sucks. So I need to swap to something else. Probably this interactive brokers. But we'll see. So I will be back tomorrow. It'll probably be to read the book. Let me drop the Discord link one more time. It's right there. Yeah. And so, yeah, that'll do it for me today. If you have any ideas about the code or anything like that, drop me a DM in the Discord or talk about it in the general chat. That's fine as well. But I will head off for today. See you guys tomorrow, and I hope you have a good rest of your day.